So again, going from the 30,000 foot view and drilling in, I will show you what I do. And I recommend that everyone do this because I do believe in diversification, just not in the traditional sense. I think it's important to more broadly diversify. And what I mean by that is having different asset classes that do not have a correlation to each other. Okay. Now, I want to give you a little bit of a preface before you see this. A lot of people have predispositions. They have feelings about asset classes. There's buzzwords, right? Buzzwords like annuity or reverse mortgage. You know, these are things that people hear and they're like, oh, those are bad. The truth of the matter is that there's a disease in the sales business. And that's anytime a salesperson doesn't have something, it's bad, right? Go to a Cadillac dealership. Mention Toyota while you're there. What are they going to say? They're going to say, well, Toyota's not a good car. You don't want a Toyota. You know Toyota's a good car, but they don't sell Toyotas. It's the same thing in our financial industry. If you go to the guy that works at the Wall Street firm, he'll say, stay away from annuities, stay away from real estate. You go to a guy that's doing the real estate seminar and trying to get you to buy rental properties, he'll tell you stay away from stocks and bonds, they're bad. It's the same thing across the board. The way you should analyze it, because I want to equip you with how to analyze things. For one, I showed you the math, the compounding return versus the average, right? So when you're shown a sales pitch regarding an investment, it equips you with the ability to ask and understand, well, what would I actually earn on this? And if the advisor's like, well, it's the 7% average. Well, then they don't understand the math. And frankly, most advisors do not understand the math because the industry doesn't want advisors to understand the math, just like they don't want you to understand the math. I mean, if you think about it, it's a lot more attractive. If I show you two investments, one's 7.4% and one's 5.2, but I don't tell you anything about them, which one do you want? Right? You want the higher one, always. And so the whole industry is based on the whole sales approach is based on using averages, which you will never earn. Now, I would recommend to everyone that you examine all of your options and you examine them by looking at their own merits, not having predisposition at all. And the way you do that, honestly, is by focusing on the cons, not the pros, right? Because every investment has pros and cons. But the cons are far more important. That's what you should focus on. Because if you want to build a portfolio of pros, it's easy. You just throw them on the wall and they stick. However, if you want to balance the cons in a portfolio and you're able to do that, then you're able to create something fairly magical. As an example, I know all of you guys came here to learn. I'm getting off track. I'll come back to the assets. Everybody here came to learn about the perfect investment. So I'm going to share it with you now. Everybody ready for this? Hope you're sitting down. This is the perfect investment. It's something that is 100% liquid. You can take your money out of it whenever you want to. It gives you a substantial return on your investment. We all want that. And it's 100% safe, right? I'm sure a lot of you already know this doesn't exist. If it did, I probably wouldn't have a job. I'd be investing in this and so would everybody else. The reality is that you can build this by balancing the cons. Think about it this way. Throw any asset at that, and you'll see that it's good at one of them, not very good at the second one, and maybe terrible at the third one, right? A bank account, 100% liquid, it's not going to give you a great return. Safe from everything except inflation, unless you find a rate that's higher than the inflation rate, which is rarely the case. Right now, you can, if you go to some, credit unions and smaller regional banks and stuff like that. There's some bank CDs out there that fit pretty well. Bank CDs, not as liquid as a bank account, can give you a little bit better return. And again, I consider it very safe. That is green money, okay? An insurance product. Now, when it comes to insurance products, I will say that I'm pretty biased about it from one perspective, and that's that there's really kind of two different fields of insurance products. There's the variable kind and there's the fixed kind. And variable simply means that you can lose money. Well, if you're going to take the risk of loss, just buy securities and pay less money in fees. I've never actually seen a variable insurance product that I liked a whole lot, because there's better alternatives. But a fixed insurance product, It's not as liquid. It's not a liquid product. It can give you a pretty decent return, but not a great return. And it's considered pretty safe. An account at Charles Schwab or Vanguard or some investment account somewhere, it's 100% liquid. You might have to pay taxes on it if it's an IRA. You can have a great return, but it's not very safe. A rental property, it's not liquid at all. It can give you a good return. And if you buy the right kind, I consider it very safe. We can spend more time on this if you individually want to meet and kind of go over some of these concerns and questions that are formulating in your minds at this point. And I'm almost done here. I won't take up too much more of your time. But the way that I believe you should diversify is by looking for as many asset classes as you can fit that make sense for your financial plan. Now, a real true fiduciary is not going to recommend products to you based on the product's characteristics, but how the products actually fit like puzzle pieces in a greater picture. And each thing has to serve a purpose, whether it's creating income, protecting assets, battling inflation, being very liquid, being an emergency fund. There's a place for everything. So what we do is we lump everything that's traded on the exchanges into one category. We call it securities. We run our investment strategies in-house. I'm happy to talk to you about that sometime individually. That is our registered investment advisory firm. But we also recommend taking a look at things like commercial real estate. And when I say that, I'm talking about actually buying real estate, not a real estate investment trust. That's also a security. I would say that right now, a caveat is I don't think it's a great time to buy commercial real estate. There's some risks there that we can talk about another place. There are alternative investments. These are things that can create tax deductions. My screen just went black. Hopefully everybody's still there. And then also perhaps investing in businesses. On the green money side, we take the best of the insurance world, and there are some pretty fantastic products out there. There really are. We look at bank CDs, which are now starting to become more attractive. Multi-year guaranteed annuities. Those are the same thing as a bank CD. They're just issued by insurance companies. They're paying close to 6% right now. And then, of course, one that I like a whole lot, and that's low-income rental properties, which we do for our clients as well. And I can tell you that most of my clients don't own them because they don't want to be a landlord. But there is a lot of, and the reason, let me clarify why I put low income. If you buy a rental property that's $3,000 a month in rent, and we go through a deep recession, it's possible you might be without a renter for a bit. However, if we go through a recession and your property's $800 a month, you're more likely to not have any lack of renters. In fact, you might even have more demand than you had otherwise. The downside, because again, everything has pros and cons. The downside here is not only is it not a liquid investment, and generally speaking, green money is not, but it also requires work. Which is why most of my clients don't own them. I bring it up every time, but ultimately you have to be willing to be a landlord. And what that means, being a good landlord is not being a good landlord from the tenant's perspective. It's being a good landlord as a business owner, which means that you're willing to raise rents. It means that you're willing to evict someone if you have to. It means you're willing to fix things when they're broken. That's hard to do. I'll be honest with you. I think most people that are friendly, easygoing people, especially a lot of people here in Oklahoma that I know well, they're just sweet souls. And it's hard. It's really hard to do that. And you've got some little old lady renting a house from you for 7 years, and you're like, I really don't want to raise rent on her. But you want to try and make sure you're getting market rents for that. Because reality is that you can get a pretty solid return the way we're targeting. And unlike an insurance product, it's actually going to go up in value over time. Whereas an insurance product might pay you a little bit more income, but it's going to go down in value over time. But then you have the pros and cons of actively involved and passive, right? So these are all things that each one of these is like a puzzle piece that has to be fit together. And then, of course, on the blue money side, we have cash, which is very simple and also incredibly important. And so not only does this allow you to control risk in a way that's predictable and certain, but it also is about layers of liquidity, right? Because you can get this money in your hands in 5 minutes. you can get this money in your hand generally in one day. It depends on the asset, obviously. And some of these, by the way, alternative investments, a caveat I have to put this out there is that there are rules that the government has. They're not my rules, but I do follow them, that you have to be an accredited investor or a qualified purchaser to invest in certain asset classes. We can talk about that individually for each of you that want to meet and talk about this stuff.
Click the card in the corner of the window to continue this webinar. Please remember to like this video and subscribe for more educational content.